Looks like we're live. Nice to see quite a few here already waiting. Uh, as usual, I'm a little earlier than the scheduled time. We have Clive and also Francis, the market sniper, joining us. They should be coming in about 5 minutes, hopefully. The title of the live stream today is Global Sovereign Debt Crisis is Now a Distinct Possibility, and France teetering on the edge as Fitch has downgraded their debt from, let's see, yeah, AA minus to A plus. So we're going to be looking at that, answering your questions as well, as usual. Nice to see quite a few of you here already. R. Elkas, younger every day, he says. Sode from Sweden, Nick the Greek, Matt Barnes says, good afternoon, all. Justin Taylor, evening, Mario and Rudy. Rudy is over here. Gianfranco Bergagna, good evening, Beauty Silver. Andy Brown, good evening, Mario Rudy, greetings from Scottish Borders. O Master is here as well. Chris Conman says, hi, Mario and Rudy. Yeah, our Elka says, yeah, 150,000 subscribers. We a new landmark, I guess. We got to 100,000 last May 2024. So it's growing. David Jackson, greetings from Greece. Jack Mahan, Mara, how are you? Your silver call's doing. No, they're not doing anymore. They expired worthless. That's options for you. I lost a little bit of money, but my profits in the miners have more than made up for it. So those calls ended up. Yeah, they expired at the end of August. So unfortunately, they didn't work out. Mark Sneed, hello, Mario, Rudy, and fellow metal, and Monaco maniacs. Maniacs. Gianfranco says, hello, good evening, Rudy. Yeah, he's having a nap. Weather's not great here. It's getting cooler and it's a bit wet. Danielle El Sereno says, hi from Hertfordshire. Helgi Inkling, good evening, Mario. What do you and Clive think about the danger of the state confiscating precious metals from private owners in Europe? Best to you, gentlemen, and Rudy from northern Sweden. I think it's going to be, yeah, I don't think it's something they're going to try to do, really. I don't think the populace in Europe or anywhere like in the Western world has that much gold. I think they're trying to do it through taxation and inflation anyway. So I'm not that concerned about it. So we've got Francis coming here. Let's put it. Okay, there we go. Hi, Francis.
Hey guys, how are you doing?
Fine. We're still waiting for Clive. He should be on in a couple of minutes. Yeah, we just had a question from someone, Francis, about whether I'm concerned about states confiscating physical gold in Europe. I don't think they are because I don't think many people have physical gold. I think they're going more through taxation of other assets that are easy to get a hold of, like stocks, pensions, and taxes on real estate, capital gains tax. What's your view, Francis?
So they throw a wide net and they slowly catch from the outside in, and then they squeeze tighter. To do taxation on precious metals, They first, is my take, need to do registration of precious metals, which is where the tokenization, the CBDCs, those kind of vectors are more convenient to have in, and the biometrics. So in terms of my sequencing of events, I think it remains a possibility. That doesn't mean I'm saying it's absolutely will happen. I think other things will have happened first, and things like capital gains taxes and immovable assets that are already registered quite clearly, like property that you referenced, are already there for the taking. But what I think I think the possibility remains, but first they need to know who holds what. That's sort of opaque. Even though most people, let's say you're in the UK or Switzerland, as the two speakers like yourself and Clive are, most people will have bought from a UK bullion dealer and a Swiss one, and those dealers would have to have some form of record. You could have moved home a lot of times. Yeah, it's not always the information might be old. You might have bought, like many of us, decades ago. So I think they want the registration, and I think they want the tokenization. Then they will control the physical held via the digital proxy, which will be, I think that's their strategy. But that makes, so I think it comes later. They've first got to capture everything and record everything. It's
Yeah.
not going to be a tax take first. It's, oh, do tell us what you have. Fill in
Yeah.
the clipboard. And then it's like, then they will compile, put it in a database, the equivalent of Palantir. If it's not Palantir, the Palantir equivalent of, for the UK, Switzerland. And then slowly then as things move, they can then start saying, well, it does seem like you've made an unfair largesse in this particular investment that may have contributed to destabilizing the financial system. They'll come with some narrative like that. And thereby, in lieu of resetting, build back better, we're all in this together. It's deemed that a once-off capital gains, or et cetera, like they did to the energy companies that they blamed for excess profiteering in the UK, which you've already had. You'll just have a personalized version of that. But before they can successfully really squeeze everybody's nuts on that one, they need to know who owns what. It's
Yeah.
much easier when you have four listed energy companies in Britain. You know where their capital offices is. When you want to start doing that to the individual citizenry, you need to have very strong controls and records. So I think the capture phase is in the gathering of information first. That's my take.
Yeah. Oh, hi, Clive. Nice to see you.
Good evening, Mario.
Good
Good
evening.
evening, Francis. Good
Uh,
evening, all your
Evening,
viewers. Nice
Clive.
to
Yeah.
see you all.
Before I move to Clive, I just wanted to let the viewers know that France's YouTube channel is the Market Sniper. If you haven't subscribed yet, you should. He's almost at 100,000. And also Clive's channel is doing well. He's at 45,000. So make sure you subscribe to that too. Clive, the title today is about the global sovereign debt crisis. But what I wanted to ask you first, someone just asked what I thought the possibility, or you or Francis, of governments in Europe confiscating, the people's physical gold was.
Well,
Yeah, so I'll let you chime in your opinion
well,
on
I
that.
mean, first of all, specifically, it's not worth it. There's not enough gold in the hands of private investors to be worth the trouble of doing that. Private investors have a lot more of everything else. So if I was a government and I want to take people's money, I'd take the other things that they've got as a first priority. Of course, it doesn't mean to say that they won't just go for a sweep if they want it and tax. I mean, the way to get it is tax, obviously, is not to really seize the assets. I mean, if it's a bank account, they can seize your bank account in a bail-in. But broadly speaking, I think the way to get things is tax. So they can, the first thing they're going to have to do is get people to register their assets. Unfortunately, we've got that already in Switzerland with wealth tax, so they already know what I've got. So if they wanted to, hopefully Switzerland won't go to the next step. But I can see wealth tax coming into other countries. And once they know what you've got, then it's very easy to say, give us 1%, 2%, whatever the number they like of that to fund the government. But I don't think they're going to target gold specifically. There'll be little point in that. It's too small, or there's too little of it in the hands of private investors to be worth the trouble.
Yeah, in the UK, gold physical gold is not considered a financial asset, so you don't have to register it. I would say that. But if you invested in the financial system with like ETFs and other vehicles for like ETFs, then I guess they will know what you have. I'm not sure. I don't think bullion dealers keep they have a receipt when you buy or sell from them, but to go through all that, I don't think is very easy. I don't think they actually keep like a list of how much gold or silver each of their customers have. So, and I think Clive, you said some time ago that they might go after the like GLD because they've got a lot of physical or other ETFs. I mean, that would be an easier way to confiscate. But I wanted to move, and I'll ask Francis first because you guys probably saw that France was downgraded Friday night by Fitch from AA minus to A plus, and I think the bond markets could be in trouble this autumn. Historically, like September and around the time of the equinox, autumn equinox, there's a lot of currency crisis going back to the 1930s. I mean, 1931 was a year where Germany, the UK went off gold. The pound yeah, it was devalued. And it happened around the 22nd, 21st of September or thereabouts. And then in 1992, we had when the pound collapsed, when Soros made $1 billion through shorting the pound. And 3 years ago, we had the trust crisis. And I don't know. I think I'm not saying it's going to happen, but if it's going to happen, it could very well be soon, September, October. So just wanted to ask what you think first, Francis, and then we'll move to Clive.
Yes, thank you for the question. And I'd like to addend almost what you're discussing, tag something on it, put a trailer on it, if that's your truck, as well. I would also point out that there were massive social unrest and political movement events over the weekend that you're probably aware of in the UK as well, that seem to be synchronized up with what is overall a very dis-easeful autumn season for the Northern Hemisphere. So in terms of European debt generally, we've consistently spoken. We're on record for since 2020, the tail end of 2020, making upside calls on interest rates and downside calls on bonds, capital values, on pan-European debt. We've run the rooster, Dutch, French, German, all of them, and Japanese and UK as well, globally, including the US. So since our call on 2020 September regarding the US debt, this has been our inherent bias on an ongoing basis. And we have a technical setup. If you wanted to do a screen share at some point, I don't know if now, maybe you just want to comment now, I'll just leave a comment then, that you're going to see the ongoing upward march of rates. Despite the notion that there's meant to be a rate cutting environment going on in America, which may take effect. Everyone's said that 25 at minimum is for sure in, with some outside possibilities of a double. I think that might signal a bit more panic, but who knows? So rates up and debt valuations down, lending environment to turn costly, hard to get, bigger mortgages, and the resultant effect on the property markets as well in most of the affected nations, as well as an asset class which is going to be beginning of a contractionary period. All dovetailed with this agent provocateur Elon Musk on X, with the likes of Tommy Robinson, a bit of a Zionist axis, trying to say fight, where they're quite unspecific in terms of what fighting actually means, which is not to say I think you should be passive, by the way, but I'm observing the agent provocateur. I feel like saying the French don't have a phrase for that, but there's very much the temperature and mood right now. So it seems like debt-based crises, looting and rioting it feels like a season 4. And that would probably be my opening comment without any further hand
Yeah.
over to Clive.
Okay. Yeah.
Okay, well, sovereign crisis likely. Yes, um, obviously these things come without warning, so there will be no warning when you get a sovereign crisis, and there's no sign that it's around the corner. Of course, the downgrade of France on Friday is a first sign. I'm pretty sure we're going to get a downgrade from S&P rating agency as well. That was, in fact, on Friday morning I did flag that as a possibility. So I think it's coming. But that doesn't mean to say that we immediately leap into a sovereign debt crisis. I think the problem comes when there's a loss of confidence by the public. And we saw the downgrade of the United States, and there was no loss of confidence when that happened. People just shrug their shoulders and say, "Oh, it's still the United States. It's still as good as gold." And they'll say that about France. They'll say, "Well, the European central banks behind them, they can print as much money as they like." And obviously, the whole point of the budget that they had in France was to rein in the excess, the huge deficit they had, which was contrary to what's allowed by ECB, the European Parliament rules. Now that's failed, but the new Prime Minister will have to bring in a budget, but he's got until October to do that. And obviously he's going to be juggling with a lot of things, but I think probably it'll come in with some sort of budget which involves higher sales taxes in France. That's my best guess at it. But they've got to balance the books a little bit better and have a smaller budget. But when do we get a crisis? Well, it just comes at some point without warning. There'll be some incident, some political crisis, some problem with rioting in the streets. We just don't know what it will be. And then, of course, you only need one country in the world, one Western country, to fail, and everybody says, "Oh my God, are we next?" So it doesn't have to come out of France. It could come out of Japan, for example.
Yeah, I've got a few charts I want to show, but before I do, I want to refer to this book here, The Triumph of Gold by Dr. Franz Pick. And this was written in the 80s. So, I mean, it's taken a long time for gold to triumph. I think it is triumphing right now. But on page, in the introduction, it's by Dr. Henry Jarecki. It's a friend of Franz Pick. And this is what he says here about what Pick told him. The most important prediction I made was very romantic. In August 1931, my new wife Peggy and I lived in Paris. That summer, she went to Bohemia to visit my parents, and knowing she would be gone for a month, I went sailing. I sailed from Holgate, the small French village where William of Normandy first gathered with the 15 men who went with him to Hastings in 1066 to England. But when I arrived there in the small town of Cowes, that's in the Isle of Wight, to be exact, I found so many other boats there that I could not moor. Small boats, one after the other, were bringing sailors to shore from nearby battleships. I asked one of the sailors why. He said, "Young men, we're going on strike." Why? I asked. "Well, for higher pay," he said. And then he talks about his professor, a guy called Knapp, Knapp. He said, "Knapp had taught me that the currencies fall when there is a rupture in the state, and I thought striking sailors were a manifestation of such disorder. I concluded that the currency had to fall, and so I ran to the telephone and called the Czech financier, Peček, to tell him to sell the pound sterling short. That was August 10th, 1931. Peček sold 1 million pounds short, half to the Czech National Bank and half to Kleinwurz in London. On Yom Kippur, which happened that year at the equinox on September 21st, 1931, sterling was devalued and Peček made $1 million. And then this guy who wrote the introduction asked, "Why do you mention the equinox?" And he says, "I have a theory about devaluations on the equinox." So anyway, I thought that was interesting. And I think the state all around the West is very weak. Someone asked me to comment on these demonstrations in London. Well, one thing I have to say is that the mainstream is very much, let's say, downplaying it. But and like Francis said, there's a lot of agent provocateurs. They're trying to get people to fight, divide and conquer. But I think there's a lot of unhappiness with the state as well. There are like genuine people protesting. And it's not just here. It's in France. It's in Germany. It's everywhere else, and even in the States, we have massive division between left and right, between the so-called woke and the red or the MAGA movement. So, yeah, Francis, you've got something here.
Yeah, just thought I'd add something.
Yeah,
You mentioned your go-to charts, and I think this feeds into the discussion very interesting. I don't think this is 100% accurate. This person is saying that it's Peter Schiff that said it, but I want to feed
yeah,
into the whole debt markets. Faulty government data hid weak jobs. This is part and parcel of the fact that the US is in stagflation for me, and this is not being acknowledged, and that I'm going to call it lied. You can say, well, made errors or bad models or whatever you want to justify, but misrepresented. And what Peter Schiff was saying, if we look at that, Scott Besson claims that since inaccurate government data hid a weak labor market, which is why we've continued to say, and you've heard me say it, Mario, many times here, you met the criteria of a recession and it was a recession. And you don't get to say, but my employment numbers are really good, so we don't count that 2 quarters of negative growth. And now we said never trust those numbers, particularly on the payrolls. And now it's finally being recanted, and that position we took back then is shown to be accurate. But the point Shift is making, which is one we also make, which is further stagflationary, is the same government and the same BLS is giving you the inflation information. And
yeah,
when we look at I've given some examples of, New York strip beef cost per pounds in dollars, 10.99 cents pounds of dollars, call it 11, now 16. In 16 months, that's a 45% increase, and annualized, that's 34%. The Walmart till slips from 2020, re-put out and checked out exact same items, 134% up. That means 2.34 times in 5 years. A whole bunch of things. So I'm not so sure about whether Besant actually said that. First Squawk's normally accurate, but
yeah,
certainly Schiff is saying it. And what we actually have is lies, damn lies, and statistics. And when we talk about the bond market and what is the true economic state, you are functioning out of, in my opinion, an empirically much higher inflation rate and in a far weaker economy, for which state has become disproportionate to private markets. And I think when you think of bond markets, you need to contemplate the stagflation. And we actually have a word where we call it hyper-stagflationary, because this time it's far more scaled than the 70s and you're far more indebted. So I just thought, feeding
yeah.
into the bonds discussion and default, that's going to, the economic environment's kind of important on that one.
Yeah, I saw that. It says that Besson said they must hike, but I think he wants a cut. So I'm going to show the chart now. If you,
Yeah, let me stop that. Sorry.
it's
You can
actually,
stop now. I've lost the control. I wish I had a stop share button, but they don't
let's
easily.
have a look. Can I do it? Stop. There we go.
There we go. Thank you.
I'll bring, it's a series. It's the same chart, but for different countries. Let me bring the first one up. Share. So this is the German 30-year yield minus the 2-year yield. And so it's the difference between the 30-year yield and the 2-year yield, and it's a positive number. It was negative here, and now it's going positive, and it's broken this trend line. And what this means, in my opinion, is that the bond investors are saying they're concerned about inflation because they're selling the 30-year German bond, and the reason it's outperforming the 2 years because the ECB they've cut rates quite aggressively since 2024, but I think they've overdone it now, and it's one of the reasons why this guy here, the new Austrian central bank governor, who's part of the ECB, he's saying rate cuts very close to end because he can see that the markets think we shouldn't be they shouldn't be cutting rates. So and then if we look, this is the UK. 30 to 20 year to 2 year, and that's broken out massively. And I think that's why the Bank of England as well has stopped cutting rates. And I think they're pausing right now. And then we look at the US 30 versus 2 year. It hasn't broken out that trend line, but I think it will eventually. And that's why I think maybe this cut that we will have on Wednesday is probably going to be a one-off. And if they try to make a series of cuts, I could see this really steep, the 30-year really rising, and it could be problematic. And then here I've got another one. We've got the Japanese. Well, the Japanese, it's out of control, the Japanese market. So I wanted to ask first Clive what he thinks about that, whether my reasoning is right or this is just normal.
We're seeing these charts demonstrate that the yield curve is steepening. So as lower interest rates are coming at the short end, it increases the possibility of inflation down the line, which means that long-term investors expect a higher reward, a higher interest rate on long-term bonds to compensate for the fact that inflation is that the lower the short-term rates go, the higher the longer-term inflation is likely to be. And that I think. And Mary, do you mind if I just jump a little bit on what Francis was talking about? Because I was kind of itching to say something about the labour numbers.
Yeah.
I think the most important point here, which is coming out of these job revisions, is that you can't trust the government statistics anymore. And my question here is, the Federal Reserve has consistently, for the last years, been relying on these official government numbers about what they call the non-farm payrolls, as if it's the be-all and end-all of the jobs market. And my question is, doesn't the Federal Reserve have an army of economists, and can't they do their own maths? I mean, I've constantly called out the non-farm payrolls number as being absolutely and totally inconsistent with what's called the household survey. So the BLS brings out two surveys. One's the establishment survey, which is commonly known as the non-farm payrolls survey, and the other one is called the household survey. And these numbers have been consistently moving in opposite directions. The non-farm payrolls number shows a fantastic number, and usually that's because they revised down the previous month or the month before that, making the current month look absolutely excellent. And then the other survey they got is called the household survey, which consistently shows more unemployment and less people employed. So the two surveys were going in literally opposite directions, and now we've got the truth just come out where they've revised down by nearly 1 million jobs or something from up until March this year, so the evidence we've got is that either these non-farm payrolls numbers were heavily flawed in the methodology they're using, or and I dread to think this is the truth because I can't believe this would be such a big conspiracy, but they're fixing the numbers.
Yeah, the year before they revised it like 800,000.
There's an overlap. Yeah, they actually
and
900 as well.
So it was 911,000, which is a
911,
weird number. Yeah, 911.
November. So, and I think the interesting part of that is I think some of that is overlapping the same period. So you're getting the number. A month or two later, you're getting a downward revision. That used to average around 78,000. It's the last two were 125 and 133 downward revisions. That's like the monthly downward revision. You're then getting to the end of the year and they're knocking out close on 1 million each time. And now you're getting quite close to the previous revision. It's less than 6 months, but I think it's actually contains some of the same period. So you're getting this is version 3.0 of the number.
Yeah.
So the dart just keeps dropping. It's like a drunk man playing darts.
My question is, why is the Federal Reserve relying on a number which, even a mere dummy like me can find out is wrong by looking at the household survey?
Well, because they have,
do that.
they have to play along with the government because they're not really independent. But we have a super chat here from Chris Conman. Thank you, Chris. If the UK accepts a bailout from the IMF, what effect would that have on the UK gilt market? Well, I'll answer it first. I think they will, if the IMF were to bail out the UK, it would be because the gilt market was in trouble. And so, like, yields spiked to double digits, and then the IMF would come in. So it'll probably help the gilt market temporarily. That's how I see it. How do you see it, Francis?
Well, I think Clive's jumped on this one before quite meaty in a previous chat. I recall him there, and I think we have very similar views. The last time the IMF bailed the UK out, I think it took 5% of its fund. And let's just remember, there isn't a bank account called IMF with everybody's money in it. They just squirrel borrowings and money from all the other sick lepers to help the sickest leper. And today, just on the United Kingdom alone, the scale that it would require in terms of the commitments to the IMF fund is on a completely different scale. So even the framing of the question of how feasible a meaningful, full-based bailout is even for a big nation like the United Kingdom. It's not the biggest, but a medium large nation like the United Kingdom as a whole is just beyond it. I think we roll into full-based reset. There may be one that triggers it. That's the first runner, because the key problem is you're now asking sick France, sick Germany, sick America to bail out sick Britain when they're all just about ready to say, but me. They're all shown up at the sick room and they're forming a disorderly scrum. And the fund is based off of them. So it's a bit like sick men with sick blood needing a transfusion. So the whole framing of the question is that I think we roll into something far larger as an outcome of this, and they're going to be required to stand up on their own for a far larger until we have a synchronized collapse. And I sometimes say on my YouTube channel, mocking the influenza era, ring a rosies, a pocket full of posies, a tissue, we all fall down. And that's done holding hands. In other words, this is a synchronized and total collapse for me.
Have you guys, do you remember this one here? I'm going to play it.
Yes.
Roger.
Ah, that's your name.
Roger.
Good. And what do you do, Roger?
I'm a financial consultant.
Ah, financial.
Yeah, I've seen this.
Roger,
Yeah,
yes.
terrific. And Roger, how's business at the moment?
Not bad, thank you. Been a bit quiet lately.
How do you mean lately?
Since the war, been a bit quiet.
Fair enough. Okay, Roger, your special subject tonight is the economies of the European community. Your time starts now. Best of luck.
Thank you.
How much does Greece owe, Roger?
$367 billion.
Correct. And who do they owe it to?
Mostly to the other European economies.
Correct. How much does Ireland owe?
$865 billion.
Correct. And who do they owe it to?
Other European economies, mostly.
Correct. How much do Spain and Italy owe?
$1 trillion each.
Correct. Who to?
Mainly France, Britain and Germany.
Correct. And how are Germany, France and Britain going, Roger?
Well, they're struggling a bit, aren't they?
Correct. Why?
Because they've lent all these vast amounts of money to other European economies that can't possibly pay them back.
Correct. So what are they going to do?
They're going to have to bail them out.
Correct. Where are they getting the money to do that, Roger?
That's a good question. I don't know the answer to that one.
I'm going to stop here, but you can see that, it's a mess. This was in 2011, 2012, and those were like the periphery. Now, if France, the UK, Germany, and Japan have trouble, I mean, I don't think the IMF has a chance, any chance of bailing anyone out. Like you said, Francis, is like the reset. But what about those charts? What do you think about the steepening? Is that a sign that it's going to be really hard for the central banks to cut? And do you think the Fed will just ignore that and keep cutting?
Me?
Yeah.
I think Clyde's summation was very accurate.
Okay.
The tendency to deal with short-term funding requirements and cut rates is going to further exemplify the steepening of the curve. And in fact, beyond just steepening, I've been talking about the fact that a lot of people, for affordability reasons, and America's right in the mix with this, they've been shortening the duration that they're putting their debt out to such a degree. And I keep just showing, I try to give visual mind and metaphors for people to help understand this. And it's like the big cog on my motorbike that I was riding today, and then the small cog. And essentially, if you put something out for 30 years, actually you need a full revolution of 30 years on the rear wheel before that debt comes back and you actually have to pay it back or roll it again. Yes, you have some interest rates to serve, but at least you've kicked that problem quite long down the road. What's actually happening in terms of reset is all the dynamite sticks as fuses are being shortened, because when you move from the big curve and you put it on the tiny sprocket, here's the news. Let's talk America because it's so important. Trump, yay, tariffs are winning. We got 30 billion in. No, you used to get 7 billion, so you got a net new 23 billion. That's for the last 30 days. What else happened in the last 30 days? Record borrowing, 550 billion. Oh, wow. What is 23 billion or 550 billion? 4%,
Nothing.
in, call it new income, if you will, on that excessive new borrowing number. Now, interestingly enough, on that 550 billion, 100 billion of that went out on a 4-week debt. I saw that same tweet you're bringing up. Yeah, that's excellent. 100 billion went out on a 4-week. So think of my little bicycle cog. Instead of having like 6 or 7 teeth and you've got the big old 33 at the back, you're actually going down to about a 3-teeth cog. And that thing is spinning like mad hell. Before the month's fully up, if you're in a 31-day month, that money is coming back at you and one's putting out again. So if you think you clog a fat pipe on the end of the debt time continuum, when you get to the much thinner pipe, you clog that up double fast. But everyone goes, oh, well, the central banks control the short end. No, they don't. Not when you pour that amount of volume of crap through that pipe. You're going to get a block pipe, and that's the end of it all. So this whole notion that they found some new place to hide and it's innovative thinking, no, they're forced to get a cheaper interest rate, which is more affordable so that they can extend and pretend a few more days, weeks longer. But the cycle of time that they are buying is getting ever slower. And with that level of borrowing I just described, all being dumped on the short end, Clive is right that they can, for now, manage that down and you'll have a steepening of the curve. But then eventually both parts, and we're talking about the full collapse of debt markets as an asset, will occur. And that's putting the stick through the wheel of the bike and all fall down. That's how I see it ending. You don't get long pieces of rope when you start chasing the short end. I'd be interested in Clive's take on that because he's got a good eye on the debt markets.
Well, borrowing at the short end to the exclusion of the long end is, for a government, a dangerous policy because you're putting far too much focus on the rollover problem of ever increasing amounts rolling over in the short run. So that's a dangerous strategy. But at some point, that does go wrong. And when it goes wrong, we get what's called yield curve control because the central bank is invited, encouraged, or told to intervene and buy the bonds at the slightly longer end or longer end that the government cannot sell to anybody else. So this is when the federal, in the United States, that we've seen in other countries, where the central bank steps in and buys from the government the money that the government has to borrow at the longer end. And what that means is the central bank prints the money which is required to buy those assets. So the asset side of the balance sheet are the bonds it buys, but to get the money for those bonds, it has a liability. The liability is the electronic printing of the money which is used to buy those bonds. So what that means is we go from what has been happening, which is called quantitative tightening, which is the shrinking of the central bank's balance sheet, to what's called quantitative easing, which is the expansion of the balance sheet because they print money, more liabilities, and they buy more assets, the bonds, which is exactly what happened in 2008 in the global financial crisis, and it's exactly what happened in 2021 when we had the pandemic. And it's what's exactly going to happen, I think, probably sometime next year when we go into a sovereign crisis. The government can't fund itself anymore at reasonable rates, and it's forced into this situation of saying to the central bank, do as you're told. And this, of course, is what we're starting to see with the US government, specifically Donald Trump, starting to take over influence over the central bank by putting in place people who will do his wishes or toe
But
his
doesn't
line.
that make the Fed the toxic bank because it becomes the buyer of last resort of assets that are hyper overvalued that should be allowed to price discovery lower?
Well, when I did Economics 101, and we're talking 50 odd years ago, well, actually it's more than that, but they used to call the central bank as the lender of last resort. And that meant lender to the banks or lender to the government. Now, I haven't heard that word being used except by me recently, but that's effectively what central banks are. They're lender of last resort to the government when it runs out of
Yeah,
money.
it was a term coined by Walter Bagehot, wasn't he? Like a 19th century journalist in the UK, central bank lender of last resort. And that clip of those Australian comedians, they're comedians, I think. They're quite clever as well about the economic side. What's worrying there is that that was in 2012.
11.
Yeah,
Yeah.
or 2011. And the debt at the time was already really big, and it's gotten even bigger now. So, and all these Western countries, they all owe money to each other. So to think that if there's trouble in France, that it wouldn't spill over is a little bit naive, I think. And that's what we need to be concerned about.
But I'm saying
Just a,
if the bank becomes the central bank becomes such a toxic bank, and you're not getting the fact that rates should in fact be a lot higher, as Peter Schiff is pointing out, and the debt far more devalued with a better return for a higher inflation rate, all this good stuff. When everyone looks at the country, they should be looking at every central bank as a black hole. It's such a toxic bank, and that they are actually playing a role of supporting a hypervalued debt market that should actually be correcting. At what point does the contagion happen? Because they are the asset owners of borrowing that a government is doing that is generally non-productive. We've all passed, all the big nations are well through the Reinhardt Rogoff 90%. Well, not all of them, not maybe Germany, etc., but there or thereabouts. What forces the fact that you can't ugly up a central bank to such an extent? When does the market just not accept anymore the monetization of the debt? It's surely not infinite, is my whole point. How does that triggering? I'm curious what Clive and you think, Mario, in terms of
well,
that.
Yeah, I'll let Clive. Yeah,
Francis,
go ahead.
Francis, I think we're both on the same page that what then follows down the line, and we can't put a timescale on this, but we know it comes suddenly, is the monetary reset. And whether that takes the form of a jubilee, where basically the debt is in some way, shape, or form just forgiven. When I say forgiven, it means that you lose your money if you've got any of this. Or whether it means they bring in another currency which has to be used instead of the old one, so they don't technically default, or whether it means some other system. But we basically get to this reset situation where the losers are the holders of not only government debt, but of debt of monetary assets, financial assets denominated in fiat, repayable in fiat of every kind. And I think that's something which comes. We just don't. I think it comes in. We have two waves. The first wave is the central bank stepping in as lender of the last resort, buying all these government bonds, expanding the money supply. Then the money supply is expanded to such an extent that everything is going crazy, and people are saying, "Well, I've got all this money. I've got to rush down to the shops and buy it before while it's still there. Buy the whiskey, buy the exercise machine, buy anything I can lay my hands on because I've got to get something to preserve my wealth." And then the situation gets to the point where the government steps in and there's a crisis. So they say, okay, reset time. Everyone's only allowed 10,000 of the new currency and you can't change any more. Whatever this, but we know that there's going to be the losers will be the holders of fiat at the end of the day. It doesn't matter which way it comes.
Yeah.
I agree 100% with what Clive said. And I mean, this is what I think gold is telling us, that they're going to go crazy, the central bankers, because they've got no choice but to print to keep the debt going. But what that is gonna do is gonna sink every currency to oblivion. And eventually you won't be able, like Clive said, I'm going to go to the shop to buy whiskey, but people are going to go to the bullion dealers as well to buy physical because that the currency is going to become, well, at some point, and that's the collapse really, at some point you won't be able to exchange your dollar, your paper dollar or pound or euro for gold, and I
I
think that's why I think it's going to be choppy day to day, week to week, even month to month. This is a monthly chart, but I mean, this looks like it's blowing off. I don't know if I'll let Clive chime in, and then I'd like to have Francis' opinion on it, seeing that he's into the technical side too.
Well, I can tell you, and I can tell everybody who's listening, the day will come when you won't be able to find anyone to sell you gold. We saw that very briefly in the 2008 financial crisis. I was sitting in a bank, obviously a private bank, so we weren't going to go bust, but that's not the way people thought. They thought everything was going bust. And they were ringing up to buy gold bars, something which we do every day in Switzerland for our clients inside banks. And suddenly we were being told by our forex desk, sorry, the our supplier can't get enough gold bars from the refineries, and now looking at a 2, 3, even longer delay before you could get delivery of your gold. Now, nothing bad happens and all the gold got delivered, but it got delivered with a delay. But obviously that caused a serious worry for those people who felt that they had to lay their hands on the gold now in case the bank went bust tomorrow.
Yeah.
Francis?
The key lesson in finishing Clive's story is don't wait till that moment, do it now and keep doing it.
Yeah,
Because there is a window closing, and I concur with Clive. There's a window closing. The unobtainium phrase, I think Mike Maloney deserves credit for that one, is coming for precious metals. Yeah, you're carrying too much fiat. You probably need cash out of the system for transacting for the quickest, easiest ease. But I think we could have a lengthy problem reaction solution in a situation for which having cash at home or some safe place outside of the bank would be useful. But the gold is the key play. It just always comes back to the same thing. I mean, the song remains the same.
yeah,
You wanted a technical opinion, so let me
yeah.
handle that because I don't feel I have to add too much more to what Clive said. I agree with that. I'll pop a pivot over to the chart side. And I'm quite eagerly awaiting the Sunday Open. I put it on a bit of a shorter time frame, a 2 hour, but it's always worth generally when other people that are not so familiar with the charts when you're first entering, just to remind them, where we are. This technical structure here is a very formidable one
Yeah,
here. And the expectation is measured moves, to the upside, for which, we still got a long way to go on top of a trend like that. We've got a medium short term target, which is just for that, because we also leverage trading inside of this. So we like to position in macro bull trends, be owners and investors in those trends, and then double up and max up on unique opportunities of continuation inside of that trend with conservative tight stop entries. And the one we took recently, so let's get out of the monthly and go back down to the timeframes for the more here and now, is this particular pattern, which was brought about when having made our 293,000 target, 3,000, whoops, roughly there, sorry. Let's take the second line, get it right, roughly there. Having made that target and had a pullback, we then had the extra blow-off moment. It's not a final blow-off, by the way. I'm just saying a little bit of hyper acceleration brought about by Trump's tariff tantrums, which can I remind everybody, especially those that are waiting on a dollar super surge in the milkshake theory, that in fact rates shot up and the dollar crashed and gold climbed, as you can see here. But that was a little bit too much too quick, and we had a bit of a correction after the fact that this all came from the 2000 level, where we'd had another similar setup like that, which I've shown many times. I can go back and show you, but I think let's just stay with where we are for now. So this is the classic for us, continuation. So we were early once on this move up. We thought that might be the breakout. Once it failed to clear that high and turned around violently, we sold, and I ate a little bit of red there, and we came back, and then we were buying again here. And that's been incredibly profitable, and most of the proceeds will be turned into fresh investment. There is a little bit, so if I talk more about the shorter term, so that's kind of the daily, I'll just expand this area a little bit more. and maybe drop a time frame for the technical assessment, and you can tell me when you've had enough. That looks like a very small time frame shooting star, hence why we've gone into another small consolidation. But as we always bias on big macro bulls, we like the continuations generally to break to the upside. So the Sunday open, which is something that might transpire shortly after we finish here, is going to be an interesting one for us, because this target, I didn't make this clear, sorry, this target over here, we still expect a 3,768 to be run. So we're still up here before you might have a rest. And we're about 75% of the way, or 65, I don't know, call it 70% of the way we were in from here. So we've got another 30% on our leverage long. So we are leverage long quite heavily, but with very tight risk. And we should be closing the leverage at the 37681. I made one other point, and sorry, I've spoken for a bit and I want to hand back, but just an additional point that might be additionally interesting for the viewers and for both of you is that if gold is to make that percentage further move, which is roughly another $120, you could find silver have a little bit of an outperformance surge, because we expect a mid 40s to 50 rejection, a third rejection. So this extra 120, if it occurs as we anticipate, on balance of probabilities, there's no guarantees in anything, we'd be closing our leverage on our gold, but we have a little bit of on silver too. And I wonder if silver will have that move that will take it into that very sensitive area that is approaching 50. So it might just be worth forestalling your technical question on silver and showing everybody on a bigger time frame how close we are to that. And in fact, if we go monthly, I think this is the highest monthly open candle we've ever had. No, not quite. Quarterly it will be. I'll just go 3 monthly to get the 90s, 80s properly in there. At the moment, at a quarterly level, you've never been this high. So if we finish the quarter, we are in September. So the end of September is a finish point. We could be closing at an all-time high for silver quarter. If this surges a little bit more into this space, this is the third rejection we are waiting for. So there might be some market disinflationary forces that are not very far away, which brings us back to your question that you gave as the message for this particular chat that we're having around sovereign debt crisis. So I wonder if gold getting another 120 gets silver into this zone, whereby it has another little handle dip back before breaking. And that to me will be the final time you'll be in known price zone area. So we think a third time. We find this technically very significant. Once, twice, 3 times. What happens that gives it a little dip back? And then this is when I will remain leveraged long with very large targets. And I would expect to hold those positions for a very long time. So I do expect one more rejection of silver at the gateway of 50, 45, 50 range. So I'm curious what the others think, and let me hand back.
Yeah, I mean, I personally think silver is going to blow right through 50. So, we can agree to disagree. As for gold, I've got a target because I'm looking at this triangle, symmetrical triangle that you did as well on weekly basis. And I've got this formation from 2,600 to 3,500. That's $900. So I expect after the break here, which was, let's see, around
3 fours.
Yeah, with 3, 4,
3.
I expect 4,300 because you do 3,400 plus 900. So I personally think and I'm talking more long term and people holding and stacking. I know you're talking more about trading paper gold, but I'm sure you also hold physical gold. But maybe if there is a sovereign debt crisis, yes, it's deflationary, but people are they're going to go for the safety of gold, I think. I'll let Clive give his opinion on that now.
When I look at the gold price and how it's behaving and what it's doing, it does look like it's almost unstoppable. But I have to say, we mustn't rely on that. I mean, many times we see in history, we've seen things which look like they're unstoppable, and suddenly they turn around on a sixpence and do the opposite of what you expect. So what I suppose I'm trying to say is, don't, investors should be have a steady hand and have to be prepared that there might be a downturn, and downturn might be severe and it might be prolonged. Now, I'm not predicting it, and I don't even think it's going to happen. It doesn't look like it, but history does tell us these things do happen. So when you're investing, don't have all your eggs in one basket on one day, but be prepared that what you do have might go through a sustained period, a down period. And I don't predict this, but if it does, you've got to have the stamina to withhold it, to bear that temporary loss, and don't get suckered into saying, "Oh my God, it's all over. I'm out of here." That's what I would say.
I agree with Clive. What he said there is about managing your expectations because, even though I said I think gold is going to 4,300 and silver is going to blow through 50, you never know. It's just my feeling. But if it doesn't, it's not going to affect my view for gold and silver long term. Engelberg Humperdinck, thank you for your super chat. Have a look at palladium chart. Hyper bullish in my opinion. Yeah, palladium is one thing. I mean, it is a precious metal, but I focus more on the monetary ones. Have you got an opinion on palladium, guys?
Well, it's used in petrol, or what they call gas engines, as a catalytic converter. But with the trend towards hybrid cars, I think that platinum will probably be the better metal to hold. But just to put the cards on the table, I do have a position in palladium, so I'm talking down my own position.
Yeah. Francis,
Yes,
any?
I think the question is correct that there is a technical turn. Again, that would be something I would show with a chart. And I want to highlight that many people think silver will be an outperformer to platinum, but I think they short sell the move. I'm like Clive. I think platinum is going to be a real winner. If you look at the palladium, my apologies, the platinum group of metals, which is actually platinum, the biggest holder, then palladium, and there's one or two others actually in there as the platinum group. Platinum group metals at least matched and passed in most periods slightly outperformed silver. But we had platinum deeply underperform because of the green agenda and the substitution that Clive was referring to. There was a move away from diesel into petrol. And platinum was being used a lot in diesel engines, and petrol was palladium. And palladium, of course, was a lot cheaper then. It was $270, and platinum at some points during that period was over 3,000. That was when gold were in the 1,700s type range. So we actually had a multi-decade, I would say almost 18 years of platinum suppression. So whilst if I'm sharing the chart, you can see I'm kind of calling a W bottom, and we were discussing this in the community. In fact, you can even say a complex head and shoulders if you wanted. There's the W bottom, but you get this little bit of shouldering as well. You can also frame it as an inverted head and shoulder. So we see upside on it. But what's interesting is that it's now much closer to the platinum price, and there's no economic benefit or very little economic benefit in any substitution. There was a huge difference back in the 80s, 90s, going into the noughties, and I might just show that. So palladium did eat a lot of platinum's dinner as being in the family. And if we have a look on the bigger time frames, if I go 3 monthly, you can see that 2009 here, you had a low here in platinum, or call it October 8. Of course, it was just after subprime, but nonetheless, a low value of $158 in the bottom of 2009. And even over here in 16, you had it at a low of $452. It's quite substantially less than platinum. And that's where the substitution. So if you can try remember those numbers, I will bring up, or let's actually split the chart so we don't have to make fools of our memory, our ability to remember. If I put platinum on the bottom, XPT USD, In fact, let's type the word. We get the same chart. Platinum, we get it numbered by ounce. We get a longer history. That one is the TVC. So if I just remove my scribbles, there it is, tidy up the chart. You'll see, for example, let's get them synced up by time as well. That's better. Okay, so the platinum up top here, around about here, its high was 2,299. At the same time, the high was 595 for palladium. So you had $600, call it, to 2,300. That's a massive difference. You're talking about something that's 4 times more expensive. And again, for example, over here, if we just take this month, or let's take the highs here, you had platinum at a high of 1,884. This is post subprime, where it got slammed quite hard, 1,884, and you were at 759. So again, it was still, you double it and you're still not at 1890. So platinum has been consistently a lot more expensive. So you can see here, platinum has started to run and palladium is turning, but the momentum is with platinum, which I think
Yeah.
is my choice. So I don't know, answering questions the listener didn't even ask, but I'd prefer platinum, and Clive said that, and I feel the charts support Clive's opinion, in that the platinum is going to be the superior investment. And that the other reason is that the palladium can no longer pull the substitution trick and get all the money flows that goes into the platinum group of metals. Platinum is going to be the winner. It's not really monetized, but you can buy quite a lot of coins in platinum, maples, eagles, etc. So anyway, yeah. So I think that's the best answer I can give regarding the two.
Yeah, and it looks like platinum hasn't really gone over the high from '08, while palladium has. The other thing about platinum, it's used for jewelry, and we could see some substitution because gold is getting so much more expensive. We could see the return of platinum jewelry as well, which would help platinum maybe.
Yes, and it's very popular in the East, of course, with the different complexion. It's kind of like a white gold, only more rare. And yeah, I find that, I think that's where the money's going to be. We have to not play the puck where it is, but play the puck as to where it's going. If in the hockey, ice hockey, or Wayne Gretzky, skate to where the puck's going, not where it is. And that's what I feel. I think there'll be immense demand there. Again, I can't see the stop share button, Mario. So if you can just.
I stopped it. Yeah.
Okay, great.
Attorney Michael Eline, thank you for your super chat. Sending you subs. You are the John the Baptist of fiat currency understanding. Thank you, Attorney Michael Eline. We got 4 minutes. Maybe we could give Clive 2 minutes to talk about the miners, because that's a really interesting sector, and then as well, Francis. So, Clive, you got 2 minutes on the miners.
Okay. So, because first of all, from a price earnings multiple, they're very cheap. And secondly, the forecasts of the future earnings are understating what's likely to happen based on the current gold price. Most of these forecasts were made by analysts 3 months ago or more, at a time when the gold price was somewhat lower than today. And because when the gold price goes up, there's a leveraged effect on the earnings per share of a gold mining company. So, to give you an example, if a gold miner is mining gold, it's costing $2,000 an ounce to get out of the ground, and it's selling it according to the last results, let's say at $3,000, it's making $1,000 an ounce of gold. But if that gold price next year is, let's say, 4,000, although the gold price has now only risen by 33%, the profits of the gold miner has doubled from the 2,000 it costs to get out of the ground to the 4,000 it's selling. So instead of making $1,000 an ounce, it's making $2,000 an ounce. So a 33% rise in the gold price for that particular miner would result in a 100% rise in the earnings per share. And that means that with higher earnings per share, it means the price earnings ratios, the multiples that we're going to be looking at next year, if the prices stay where they are, will be, and they won't, they'll go up, but I think, no, not investment advice, but if if the prices were to stay where they are, the price earnings ratios next year are going to look very, very low for companies in the gold mining sector, and they're currently looking low as they stand. So, with even lower P ratios and what will seem like high growth, I'm very positive about gold miners in general. And if you're interested in it, I have just done a video about a day and a half ago about gold miners. You can look for it on the Clive Thompson channel.
Yeah, okay, I'll let Francis then give his take on the miners.
I think what's convenient always to see is when like-minded people just work off the facts and the numbers, they keep coming to the similar conclusions and opinions. And again, I think Clive is accurate that there's real opportunity in the miners. You essentially have a recession for costs. And we've continued, there were a lot of commodity bulls, and we've continued to prioritize the reserve asset commodity, if you can call it a commodity. I don't even think of it in that same, I consider it real money, of gold, because this is a reserve asset-based crisis. The debt instruments are failing. Other people wanted to buy, energies, for example, oils and all of that. And these have underperformed because of the not understanding the economic model of stagnation inside inflation. So what you have with a miner is actually you have a low wage growth environment because there's quite a poor, shitty employment market, for want of a better word. You have relative very low costs of energy by oil to the current gold ounce value. So you've had a divergence in gold, silver. We traded the cross. We gave everybody the inverted head and shoulder on the gold to oil. Apologies, I said gold, silver. I mean gold to oil in the energies market. So you actually have the costs of the business almost in recession. And you have the high, it's always about, the revenue number and then the cost number, and to become a more profitable business, maximize the revenue and reduce costs. That's your margin. You're actually getting the entire structure of the world doing this at a macro level for all miners. You've got weak employment market industry-wise. You've got weak growth. You've got a poor consumer. You've got an absolute blasting out top line number, thanks to central banks' consistent ongoing purchase and the deheralding of debt as an asset instrument and the hegemon of America, blowing out your top line. So now you're making mega sales, and it's only looking to go further because we haven't even really begun the full debasement process of the debt markets to its full. We've had a 55% correction on the TLT since the highs of debt valuations at 22. This has to go substantially lower. I just gave you a number of 550 billion added in 30 days. That's 1.1 trillion every 2 months. You want to add another 550 to that and get a quarter. You're running at 1.6 plus a quarter. By the time you annualize that, you're adding 4 times 1.6. It's ridiculous. It's at 6.4 trillion. That's all in its debasement, in finding a new home, has to run into the long-standing, unparalleled reserve asset. And that's the top line number for a mine, gold price.
No, they're going to be.
While everybody else is absolutely wrecked, there won't be much traveling going on by Joe Soap and even, the reps and people like that. There's not going to be driving. There's not going to be going. No one's going to be buying like gangbusters on Amazon. Even if they lock you down and shut down every other business, they're not going to have the shekels to do it. So you're going to have a recession in oil price. Look, long run, because of the fiat debasement, oil will go up. And it will have its turn, but this is a debt-based crisis. So you have a structural, and on top of that, you've got an industry that has been scorned, hated, not interested in, completely disengaged from by Wall Street, that have been playing the game of the financialization of everything, which is the loading up of debt, which includes buybacks, which has seen borrowings even being entered to because debt was cheap at the time to buy back stocks and goose a stock price. So you have a fraudulent economic Ponzi scheme driven by debt creation fiat that has ignored real money. that is all suddenly waking up to a business that's about to blow out its top line and is going to consistently run unders on costs. I mean, is there a more ideal investment environment? I can't sell it any harder. The miners are going to absolutely shock people. They might even embarrass the crypto markets.
Wow, that's great. Thank you, guys. I agree with you on that, Francis, and also Clive. Yeah, make sure you check out Francis' YouTube channel. It's The Market Sniper, and also Clive's. It's Clive Thompson. Clive and Francis, thank you for coming on, and I wish you all a great week. Also, the viewers, and thank you for being here. Take care.
Great
Thanks,
chatting with
everybody.
Clive and yourself, Mario. Have a good evening, everyone. Bye-bye.
Thank you.
Bye.
Okay. All right. Oh, he's gone.